Welcome to the Investing Podcast presented by Tusk Media. This is Outsider Trading, an audio and video deep dive into the people, places, and things that we find most interesting in the market.
Hey everybody, welcome back to The Investing Podcast. We're covering earnings reports this week. In this video, we have our senior equity analyst, Ben Nye, discussing Bank of America. Thanks for joining us.
Okay, well today we're going to be talking about a variety of earnings reports. Bank of America, Brian Moynihan, he went from being the pariah to really being the hero on Wall Street. People love him. They love how he ring-fenced the countrywide acquisition, which was probably the worst acquisition in the history of the United States on a dollar-by-dollar basis. And I'm even including HP's acquisition of Autonomy on that. You could argue that Bank of America's acquisition of Countrywide in 2007 was one of the factors that actually created the financial crisis. So Brian Moynihan deserves a ton of credit for ring-fencing that and allowing that to become a smaller and smaller piece of the book. What's really interesting about Bank of America is that their trading business was through the roof. Their trading revenue was $4.1 billion. Equities trading revenue was $1.5 billion versus the estimate of $1.2 billion. And although their fixed income currency commodities trading came down a little bit lower than expectations, still really strong results on that trading side. What's really interesting though, and I really wish I could learn the formula for this, but on the equity side, the company did not have a down day in the quarter. They made money trading equities every single day in Q1. I don't know how they did that. I mean, they should just start a hedge fund. Like just spin off a Bank of America and Merrill Lynch hedge fund, because that was extraordinary. Moynihan actually says that the trading business is, quote, and he said this on the conference call, very low risk. Like I said in my internal write-up, I'm glad front-running the orders these days is legal. Fixed income was just tough because they had a really, really tough year-over-year comparison. What's really important, and when you're looking at the banks, it really comes down to the efficiency ratio. Are you reducing the efficiency ratio at the speed analysts want you to reduce it at? And Bank of America is doing it. JP Morgan's doing it. Citi almost doing it. Wells Fargo going in the wrong direction. But for Bank of America, it's 13 quarters in a row in which they've improved operating margins. You can see this sometimes in the conference call. They're getting a little bit full of themselves. On the loan growth, it was a little bit slower. I think that's just a macro thing. Things were a little slower in Q1 than they were in Q4. We've talked about that a lot. And then again, like Citigroup and like Wells Fargo and like JP Morgan, they actually are a lot more sensitive to the short end of the curve than the long end of the curve, which means that if the Fed keeps raising rates, even if the 30-year goes down, you're going to have improved net interest margin at Bank of America. In fact, 75% of the interest rate sensitivity comes from the short end of the curve. What's interesting on Bank of America is actually two things they're doing a little bit differently than the rest of the business. On the first side is digital. Now, everyone's going after digital, but Bank of America is doing it a little bit differently. They're doing digital mortgage, which Wells Fargo actually also rolled out this quarter. They're doing auto loans. Auto loans, 50% of Bank of America auto loans were originated online. And they're doing this Erica digital assistant. So Erica, which is Bank of America's Alexa, you can tell Erica to send $5 to Greg, my production manager here, and $5 will just get sent to Greg through Bank of America's Erica assistant program. So that's one thing that they're doing a little bit differently than the others. And they spent a ton of money doing this, by the way, just a ton of money. And they think that's going to reap benefits for the next decade. And I feel like a lot of analysts are going to be piling on that whole narrative in the coming quarters, because they think that digital is the way of the future, which it probably is. And they think that Bank of America is on the leading edge. It's not going to be too much of a stretch in a couple quarters to turn on CNBC and say Bank of America is now a tech company. They're going to say that. I guarantee it. I'm not going to guarantee whether Bank of America is a tech company. That's for someone else to say. But I will guarantee that someone will say that. Just watch CNBC. Actually, don't watch CNBC. Watch Tusk Media. On the mortgage side, one thing they're doing differently is that they're actually holding the loans on their books. They're not securitizing these loans and packaging them and selling them off. Now, maybe part of that's due to the fact that gain on sale margins are getting absolutely obliterated right now, as you saw at Wells Fargo. They're actually holding more of the mortgages on their books, servicing the mortgages in-house, owning the mortgages in-house, and content just to wait for the long stream of income that that they have. Because when you originate a mortgage, there are two things that you can happen. One, you can sell it, and you make a margin. Boom, got it. Move on to the next one. Or you can originate a mortgage, hold it on your books, and just take that cash flow as it comes over the life of the mortgage. So that's what Bank of America is doing. That's not what the other banks are doing. They think that some of the other banks may go there, but that's not what they're doing yet.
Tusk Media is a subsidiary of Narwhal Capital Management. Ratings and reviews of Tusk Media content are not to be construed as endorsements of opinions, analysis, or services offered by Tusk or its parent company. The opinions and predictions shared here are our professional beliefs at the time of publication. We are not under duress from any of the corporate entities mentioned. This is not a solicitation to take any particular action. Although we are investment advisors, this information should not be considered investment, legal, or tax advice. We strive to be as impartial, insightful, and accurate as possible. We base our opinions, analysis, and calculations on information we believe to be reliable, but we cannot guarantee its accuracy. We can, however, guarantee that our opinions will sometimes be flat out wrong due to a variety of factors. Employees and clients of Narwhal Capital Management may or may not hold positions in the securities detailed and may or may not hold these positions in the future. A full list of all securities purchased, sold, or held during the 12 months preceding the date of this publication can be provided upon request. Unless otherwise noted, all data accessed via MarketWatch or the Bloomberg terminal. Past performance does not guarantee future results. A copy of Narwhal's Form ADV is available at the SEC's website, www.advisorinfo.sec.gov, or from Narwhal upon written request.